Hey, what's up you guys? It's Michael here. As most of you probably know, there are literally hundreds of different ETFs available on the ASX. But what you may not know is that the vast majority of them are being issued or managed by one of 5 major ETF providers. And in 2019, over 90% of the ETFs invested in were actually being offered by the top 5 issuers, these being Vanguard, BetaShares, iShares, VanEck, and Magellan. And whether that's a good thing or not, well, that's not really up for me to decide, but that's the reality, and at least there is a decent amount of competition available and offerings available, and we're not just all investing in Vanguard ETFs, for example. Now, obviously, if you clicked on this video, you will know that it will be focused on VanEck, who definitely aren't the largest ETF issuer in Australia, but they are probably one of the most unique. And in this video, I'm going to cover a few different VanEck ETFs that I think are worth watching out for and potentially investing in depending on your situation and investing strategy. We'll look at what, in my opinion, is the best Australian shares ETF, the best global shares ETF, the best one for emerging markets, the best for dividends, and then what I would also consider the best overall ETF by VanEck available on the ASX. Now, I mentioned that VanEck is one of the most unique ETF issuers in Australia, and this is because they specifically focus on providing ETFs to provide investors with opportunities to invest in often underrepresented sectors or asset classes. And they actually go about this in quite a different way to some of the other larger ETF providers like Vanguard, for example. A large selection of the ETFs VanEck Australia provides are actually tracking indexes that have been designed with what they call a smart beta strategy, or they're often thematic in nature, which are very different to just the standard passive indexes, like I mentioned, that are just tracking the overall market, like the ASX 200 or S&P 500. And what this actually means for you is that these ETFs have the potential to actually outperform or underperform the market as well. Now, going down history lane for a little bit, we've found that investing has become a lot more sophisticated in recent years. When actively managed funds were first offered to investors, performance was really uncertain and the costs were really high. Sometimes the returns were good, but often they weren't. And many people found this a poor bargain and moved to much lower cost passive funds when they came out, which tracked traditional passive indexes. And with these new passive index funds, returns could be thought of as average. They wouldn't be high, they wouldn't be low, they would always be whatever the market average was. And new innovations in index design for passive funds like these have been able to deliver above market returns over the long term while retaining these low costs. And this is what we call the world of smart beta and thematic ETFs. And ETF providers like VanEck are really at the forefront of this sort of new world of ETFs, with lots of smart beta products that combine both active and passive management styles. But the result is basically portfolios that are able to outperform traditional benchmark indices, all while being able to retain the benefits of all these passive ETFs, such as low costs, transparency, liquidity, and ease of trading, as you can just trade them directly on the market. Now, what I've done for this video is done a lot of research on all the VanEck ETFs available in Australia and compiled this to actually save you time and hopefully identify some investing opportunities for you. And if you find this kind of content useful, please hit that like button down below, as it really does help me out a lot. Now, without further ado, let's jump straight into the video and have a look at the first category, which is the best VanEck Australian shares ETF. This ETF is quite an interesting one compared to many Aussie shares-based ETFs like VAS or A200, as while it does give investors exposure to a diversified portfolio of Australian companies, it does so in an equal weighting per holding rather than a market capitalized based weighting, which most of these ETFs use. And the ETF I'm talking about is the VanEck Vectors Australian Equal Weight ETF with ticker MVW. The index this tracks is called the MVIS Australia Equal Weight Index, which is basically a rules-based index that combines benchmarking with blue chip characteristics by tracking the performance of the largest and most liquid ASX listed companies across all sectors, which generate at least 50% of their revenues from the Australian market. And companies in this index are, of course, equally weighted in holding. And what this actually means is that the ETF always aims to have an equal percentage holding in each company within the ETF itself, which is, like I said, very different to the market capitalized based approach for most other Australian shares ETFs. But as you're probably wondering, what does this actually mean, or why does this matter? Well, historically, it has meant that versus ETFs like VAS and A200 that use this more traditional ASX 200 index, the equal weighting index has actually outperformed them every single year. And if we dig a bit deeper into the historical returns, we see that MVW has actually returned about 9% per annum over the last 5 years versus about 7.3% per annum from the ASX 200, which is actually a pretty significant difference. But you are paying for it with 0.35% per annum in management fees, which is basically triple the cost of these other ETFs, which are normally around sort of 0.1% per annum. But we can really see where it is getting this difference in performance, as the holdings are very different compared to the ASX 200. There are currently 97 holdings in MVW, and the top 10 make up roughly 11% of the portfolio. Whereas in VAS, the top 10 holdings make up approximately 40% of the entire ETF. MVW is a great ETF to consider for investors who really want that core Aussie exposure, but with a much greater diversification across companies and sectors than a traditional market-weighted ETF. And because of this, it has the potential for outperformance against the ASX 200, which it has done so over both the long term and also the short term in basically every single year since it's been around. Next, we're going to be moving on to a category that requires us to expand our outlook beyond just Australia, and that's the best VanEck ETF for global shares, which at a time like this can be a pretty useful way to invest, given that there is so much market volatility right now, and it is really hard to understand or comprehend which countries are going to outperform, and that's really where having global exposure is something to consider. Now, what I would consider the best VanEck ETF for international market exposure is the VanEck Vectors MSCI World ex Australia Quality ETF, also known as QUAL or QUAL. And before diving into it a bit, I think there are a number of reasons why you should include international shares in your portfolio, and specifically why QUAL is a good way to do this. Firstly, you get a lot of geographic diversification. The Australian stock market only represents about 3% of global stock markets. So if you're just investing in Australian companies, you're really not getting true exposure to the overall world and market. Secondly, you're going to get much better sector diversification. Australia is really dominated by two industries, resources and financials, with limited opportunities in things like technology and healthcare, where we're seeing a lot of growth. And if you're not getting exposed to these sectors, you're just going to be missing out on a lot of that growth. And then thirdly, you're just going to get exposure to different economic cycles, which is, very useful since you're already being exposed a lot to the Australian economic cycles if you're a homeowner or you're living in Australia. So getting global exposure is always going to help in that regard. Now, QUAL has a diversified portfolio of high quality international companies selected on the basis of three main attributes that go into its quality index. That is high return on equity, stable year-on-year earnings growth, and low financial leverage. Through this quality indexes strategy, QUAL has actually had significant returns compared to the standard World ex Australia ETF, which is actually the index that the VGS ETF by Vanguard tracks. And over the last 5 years, QUAL has returned over 14% per annum, with most of it coming from capital return rather than income return. Management fees are actually fairly reasonable for this ETF at 0.4% per annum. And again, just as an FYI, all returns I'm discussing are already net of any management fees. The QUAL ETF is well diversified in terms of holdings, with around 300 or so at any time, and provides that global diversification. However, it is quite concentrated within the US, with over 70% of the holdings coming from US companies. And you don't get any currency hedging with this ETF, which means you will be exposed to any fluctuations in currency values between the Aussie dollar and the countries that QUAL has shareholdings in. There is actually a version of QUAL that has hedging available called QHAL, which is otherwise identical to QUAL. However, you obviously need to pay a higher management fee, a premium of 0.03% per annum to get that hedging. Now, if you're not really interested in getting global exposure and are looking more towards investing in emerging economies for higher potential growth, well, I've got you covered with the best VanEck ETF for emerging economies, and that is the VanEck Vectors China New Economy ETF, or CNEW. Traditionally, economies like China have really been dependent on financials, energy and materials. As GDP per capita has been increasing, domestic policy has been focused on really transitioning the economy to be a lot more consumption-led. And there's really been four main forces behind this transition to more consumer-based sectors. and they've been replacing the really traditional heavy industrial and low-cost sort of manufacturing economy that China's been known for. And they call this the new economy, and this is the sectors that the Chinese New Economy Index tracks. So CNU seeks to provide investors with access to a portfolio of the most fundamentally sound companies with the best growth prospects in the consumer discretionary, consumer staples, healthcare, and technology sectors that are both domiciled and listed in mainland China, with the aim of providing investment returns before fees and other costs which track the performance of the CSI Market Graded China New Economy Index, which consists of 120 of the most fundamentally sound companies in these industries and are publicly traded in the Chinese stock exchanges, both in Shanghai and Shenzhen. This index seeks to identify companies in China in those 4 industries I mentioned that have drivers for long-term capital appreciation. The index is also equally weighted and is rebalanced semi-annually, giving companies an equal opportunity to contribute to the performance of the overall index, which is actually pretty useful for a growth or a new emerging markets index, because you never know which companies are going to be the ones that drive this, so it is really useful to have that equal weighted exposure. Now, the returns of CNU since inception have actually been pretty spectacular. It was launched at the end of 2018 and since then has returned almost 40% per annum. Now, obviously that's not a long enough time to accurately gauge the true performance of the ETF, but we can, however, look at the index itself that it's tracking, and over the last 10 years, this has still returned over 15% per annum. Now, this has come at quite a heavy cost, with the management fees of CNU being 0.9% per annum, which is really high and probably one of the highest fees of any passive index ETF that I've ever seen. But this is quite indicative of the challenges and costs associated with trying to invest directly into these Chinese companies via the Shanghai and Shenzhen stock exchanges. Because of these highest fees, it is really one to only consider investing in if you have strong conviction in the further growth of the Chinese economy versus the rest of the world. Personally, I am pretty bullish on the future outlook of the Chinese economy, and I like that it provides a lot of sector diversification versus many of the other traditional ETFs. Now, I haven't forgotten all of you who love those sweet dividends. This next ETF is what I would consider the best VanEck ETF for dividend income, the VanEck Vectors Morningstar Australian Moat Income ETF, DVDY. DVDY gives investors exposure to a diversified portfolio of dividend-paying quality ASX listed companies selected by Morningstar. And it aims to provide investment returns which track the performance of the Morningstar Australian Dividend Yield Focus Index, which aims to capture the performance of the 25 highest paying dividend listed companies on the ASX, excluding any REITs that meet Morningstar's required criteria, combining both its economic moat and distance to default measures. This index really just combines the Morningstar moat research with companies that are least likely to default, as they found that the less likely you are to default, the less likely you are to cut dividends. Now, if you're curious about what this moat philosophy is, moat investing provides a guideline for how to approach an investment portfolio by applying a consistent forward-looking process to identifying companies with sustainable competitive advantages. And what Morningstar does is use this philosophy, which many investors would typically apply in their own stock picking, into an automatic investment strategy that can be applied via these passive index ETFs. Now, DVDY by VanEck is actually brand new, only launched the ASX in September of 2020. So again, not really any historical returns to go off. However, over the last 5 years, the index it tracks has returned over 6% per annum and pays dividends out quarterly. It typically has around 25 holdings at any time and has management fees of 0.35% per annum. Now, some of you might actually recognize this index as it was actually used by a now closed ETF by UBS, listed on the ASX as DIV. This was closed and delisted by UBS early this year in July of 2020 due to a lack of traction despite being around for around 6 years. So I would really only think about investing in this ETF if you are really a pure dividend investor and you're looking for a passive way to invest in quality dividend companies in Australia. Personally, I do think there are probably better dividend ETFs out there on the ASX, and I've talked about them on my best dividend ETFs in Australia video, which I'll link above. But VanEck doesn't really seem to focus on dividend ETFs in Australia and didn't have many available at the time, so this was the best one it offered at the moment. Now we're finally here at the category for Best Overall VanEck ETF. This ETF has been around on the ASX since 2015 and on the New York Stock Exchange, also by VanEck, since 2012. So it has quite a bit of history as an ETF itself. The ETF I'm actually talking about here is the VanEck Vectors Morningstar Wide Moat ETF, also known as MOAT. MOAT gives investors exposure to a diversified portfolio of attractively priced US companies with sustainable competitive advantages according to Morningstar's equity research team. And it tracks the performance of the Morningstar Wide Moat Focus Index. And over the last 5 years, MOAT has actually returned over 15% per annum. And over the last 10 years, the index it tracks has returned over 18% per annum. With management fees of 0.49%, it's definitely not what I would consider a cheap ETF, but with the returns that it has, I'm definitely not complaining. Now, obviously, now that you know a little bit about VanEck ETFs and also the name was a big indicator, the index that this ETF tracks uses something called a moat investing strategy, which is something Morningstar is quite well known for. However, they actually have a few different definitions and types of moats. So what Morningstar does is actually assign an economic moat rating to each of the 1,500 companies that they cover. And they define this as a sustainable competitive advantage that allows a company to generate positive profits for the benefits of its owners over an extended time period. And of all the companies that Morningstar covers, only 14% have a wide moat rating, 43% have a narrow moat rating, and 43% have no moat rating. And for a company to earn a narrow economic moat, the returns must actually be more likely than not positive in 10 years from now. And there should be no substantial threat of major value destruction. And then on the flip side, for a company to earn a wide economic moat rating, these returns must be with almost near certainty positive from 10 years from now, and in 20 years still be more likely than not to also be positive. And since this moat ETF uses that wide moat rating, all the holdings in the ETF, currently 48, should theoretically have positive returns with near certainty in 10 years. And when you look at the holdings, which by the way are also equally weighted within this ETF, you can see that they're all stable, highly profitable companies that tend to have highly defensible positions against competitors. Now, the main downside of this ETF is that it only has exposure to US-based companies. However, given the fact that over the long term, it has a total return of almost 20% per annum. This is why I would still consider it a very strong ETF choice and the best overall ETF that VanEck currently offers. Combined with its track record and the fact that it's available in the US and they've brought it over here because it's so successful there, I really do think it is one to consider. So there you go, guys. Those are what I would consider my top 5 VanEck Australia ETFs on the ASX in each of their respective categories. And I'm sure these will be eventually changing over time, but as of right now, these are what I think are the best ones. And I'd love to hear from you guys in the comments if you're using any of the VanEck ETFs that I've talked about, or maybe some others, and please let me know what you'd like me to cover next. So with that said, guys, thank you so much for watching the video. I really do appreciate all the comments, the likes. It's really nice to hear from you guys. Make sure, if you haven't already, to subscribe and hit that notification bell. I post videos about investing, finance, and money. And otherwise, destroy that like button, and I will see you guys in the next video. See ya.